Good afternoon, everyone. Welcome to our webinar, our last webinar for this year. Our next webinar will be in February, so on the first Wednesday of February next year. So just make a note of that. A lot has happened, of course, in the last month, and we've got plenty to talk about. First of all, I'd like to start off by discussing the American economy, which is growing rapidly. Over there, the fund managers have said that they're going to put 10% more of their capital into the stock market than they did last month in October. So they are becoming more bullish on the S&P 500, and for good reason. The profits coming out of the S&P 500 companies are beating all expectations. And of course, they're especially concentrating on what are called the FANGs, the FAANGs, which is Facebook, Amazon, Apple, Netflix, Google. That is the companies which are known as the FANGs. And they are, of course, all are IT-involved companies, telecommunications and computers. And they are the fast-growing companies in America right now. The average analyst in America, as measured by Bloomberg, is expecting the S&P to rise at least a further 12% before it peaks. So this is above its record high of 2930, which you should see on your screen there. That record high, which was made on the 20th of September this year. And of course, since that record high, we've had a 10% correction. And inside that 10% correction, you can see that we've got a nice double top here and a double bottom. The double top is at 2810, 2810, and the double bottom is at 2146, as I recall. 2641. So that's the double bottom. And of course, you can see this one day here where we broke below that double bottom, but that day is actually Black Friday, and I know that in America they have Thanksgiving on Thursday, and then the next day most people are on leave, and there's just a few people in the stock exchange, and the volumes are very, very thin. So this is what we would call an aberration in technical analysis. In other words, you should basically ignore it. And then you can see after the double bottom, the market has moved up quite strongly, obviously gaining some confidence from the double bottom, and it's moving back up towards this resistance level here at 2810. And obviously a key question will be, will it break above that resistance? If it breaks above that resistance, I believe, and closes above that resistance, then I believe we're on our way to break to a new record, all-time record high above this 2930 over here. And you may recall that some time ago we published an article predicting that the S&P 500 would go to 3027. It's not there yet, of course, but it is a lot closer than it was when we published the article in December of 2016. That was based, of course, on a point-and-figure horizontal count, which took us to 3027. So we believe that that's at least what will happen, and in fact we think that is very conservative, and that the S&P will go a lot further up than that. All right, now I'd like to just talk a little bit about the political situation in South Africa. And here I must just stress the fact that I'm not putting any political opinion or viewpoint, because we are looking at the markets. We're looking at this thing from an investment perspective. What is your take on what is happening politically from an investment perspective? And when you are considering things from an investment perspective, you must focus on what will happen rather than on what should happen. Okay, so it's nothing to do with whether you support this party or that party or whatever. It's about what will happen, what you think is most likely to happen, as opposed to, of course, what you think should happen. So, in that scenario, what we can see is that President Ramaphosa, since he got elected to office, has basically been cleaning up the government. He's been sorting out state capture and dealing with the Gupta problem. But his position is very tenuous. He's not holding that position of president or leader of the ANC with a very strong majority. and his position is entirely at the discretion of the 80-member National Executive Committee, the ANC's National Executive Committee. And just to give you an idea, there are quite a lot of people on that NEC who are not exactly supporters of Cyril Ramaphosa. One of them, of course, is our friend Gigaba, who was the Home Affairs Minister until he resigned in a cloud of scandal just a few weeks ago. Another person that's on that NEC, of course, is Zwane, Mosebenze Zwane, and he was the Minister of Mineral Affairs until he was removed by Ramaphosa in his first cabinet reshuffle. So what I'm trying to say to you is that President Zuma's position is tenuous, and that is why he cannot tackle the really big issues in South Africa, in the South African economy, which really need to be addressed, the structural issues. However, he has made significant progress. He's put Pravin and Gordon in charge of the state-owned enterprises, and Pravin Gordon has been going through those state-owned enterprises and putting in new boards of directors, getting rid of their old CEOs, getting rid of anyone who had any connection with the Guptas and so forth. And of course, some of those people are fighting back. We've seen Siyabonga Gama from Transnet and, of course, Tom Moyani from SARS, both fighting to get back into their position, but I don't think they have much chance. And the important thing is that they no longer are in those positions, so there are more, economically minded people in those positions, people who are not really necessarily looking to see how they can feather their own nests, but looking to see what is the best for the country. So Ramaphosa's got three really big issues that he needs to address as soon as he has sufficient political power. The first and the most important of them is the power of the unions in this country. The unions in South Africa have a disproportionately large amount of power. The laws in this country favor the employee and are working against the employer. And the result of that is that we have a very high level of unemployment in this country. So that's the first issue. He needs to tackle the unions and deal with that and redress the balance, put more power in the hands of the employer, and less in the hands of the employee. Just to give you an example, in America, they have a labor legislation which entitles any employer to fire his staff whenever he wants to. He doesn't have to give them a reason. He doesn't have to give them a letter of warning. He doesn't have to wait for a time period. He can just say, collect your check and clean out your desk and you must go. And because they can fire people so easily, they are much more willing to hire people. In this country, especially small businesses, are terrified to employ people because once you employ somebody, you just can't get rid of them. And it's very expensive and very difficult. So they don't employ, and that's one of the reasons why we have such a high unemployment rate. The second major issue which Mr. Ramaphosa needs to address is the size of the civil service. The civil service in this country is probably at least twice as big as it needs to be. And he needs to cut back on the number of civil servants. And that is obviously a very urgent matter. He could do with half the number of ministries in Parliament. And I think he knows this, but he cannot really tackle that issue without, of course, coming head to head with the unions. So he's not doing that at the moment because it's just too difficult, actually, right now to deal with that. And then, of course, the third major issue that he has to deal with is the size of the government debt, and particularly the government guarantees which have been given to state-owned enterprises like Eskom. So I think that he is waiting until after the election when obviously he will have a mandate. Right now he's simply replacing Jacob Zuma because he was the deputy president. He's not been elected by the democracy, and his position is not as strong as it could be. And he depends on the support of the NEC. That's something you have to remember. So in the election, what is likely to happen? Doesn't matter what you want to happen. Think about what will happen. That is the important thing, because that is what will affect your investments on the JSE. So from our perspective, it seems probable that the ANC will get returned. probably with at least the support that they had in the last election, which was about 54% of the vote. If they get less than that, or worse still, if they get under 50% and have to make a compromise with one of the other parties, then Ramaphosa's power to change these big things will be severely curtailed. And that is something to bear in mind. The reason that we think the ANC will probably be returned with a similar majority is because the DA has spent quite a lot of time committing basically political suicide with this whole matter of Patricia de Lille. She's now broken away and setting up her own party, which will undoubtedly take some votes away from the DA, and I wouldn't be surprised if they lose at least 3% of their votes to her new party. At the same time, the EFF, which is his other major opposition in Parliament, the ANC's other major opposition, has got itself mired in allegations of corruption and self-enrichment and scandal. And obviously that will tend to reduce their support in South Africa. So I think that his two main opposition parties have sort of committed political suicide, and that leaves the way open for Ramaphosa to get a good support in this next election. And if he does get that support, then obviously he will address the main structural issues in the South African economy. Of course, we've had two ministers who resigned since I spoke to you last. One is Nene and the other one is Gigaba. They both resigned because of scandals which they were involved in. And these, of course, this is the first time this has happened in South Africa. And maybe it sets a new precedent. Of course, everyone is now looking at Batabile Dlamini, who's also a minister and who's also been found to have lied under oath. But of course, you mustn't forget that she is head of the ANC Women's League, and therefore she cannot yet be dealt with by Ramaphosa. He has to wait, I think, until after the election before he tries to deal with that. But the cabinet reshuffle, which he was able to do, he combined two ministries, so he got rid of one ministry. That's a step in the right direction. And of course, he appointed somebody who's a very strong supporter of his in the form of Stella and Ndabeni Abrahams. And so the cleanup progress is continuing. And as it continues, of course, overseas investors are coming back to South Africa, and that's having a positive effect on our economy and on our rand. Now let's talk a little bit about the economy. The big problem in the economy, of course, is Eskom. And as we've seen recently, as was announced in Parliament, they now have to pay 45 billion rand a year just in the interest on their debt. And of course, this situation has got far worse than it was a year ago when Ramaphosa took office. And one of the reasons for that is that they have undermined the new CEO that they put in there. They put in this guy Hadebe as the new CEO. He had a track record of turning around organizations and cleaning things up. And the first thing he said was, well, we're not going to have a pay increase this year. We're going to go with a 0% pay increase. But because the government is still not ready to deal with the unions, Pravin Gordhan stepped in and insisted that they get basically what is an above inflation pay increase. So Eskom is paying his staff more than it was previously, and that's because the government has stepped in. Of course, the other effect of this has probably been to completely demotivate Hadebe and his board of directors. He was brought in there to clean it up. When he tried to do something to clean it up, he was overridden. So that is obviously not good. The only real solution, long-term solution for Eskom is to sell off its power stations and to get out of the power generation business and get into and just to stay as an electricity distributor and sell off its various power stations and buy electricity from whoever can supply it at the cheapest rate and then supply it to the public at cost. That is the best thing that could happen to Eskom, but I don't see it happening for quite a while. Of course, the other problem that Eskom has is that the municipalities owe it over 17 billion rand. So the municipalities are not paying their electricity bills. They're collecting money for that, but then they are spending it on other things, with the result that they can't pay Eskom, and now Eskom wants to turn the power off in those municipalities. And there's a big court battle going on about whether or not Eskom can supply power directly or whether it has to go through the municipalities. And that will be decided by the courts in due course, no doubt. Of course, the other major things that have happened in the economy, we had a 25 basis point rise in the interest rates. So the interest rate was put up by 0.25% by the Monetary Policy Committee just the other day. They have the objective of bringing the consumer price index, the CPI, down to the midpoint in the target range. So the target range is between 3 and 6%. Obviously the midpoint is 4.5%. And the Monetary Policy Committee is trying to bring inflation down to that level. Of course, another factor for them is the strength of the rand. And the 0.25% jump in the interest rate has certainly helped the rand to strengthen. It's now well below 14 rand, and we'll have a look at that in a moment. Of course, the petrol price, which is going down tomorrow, or today, tomorrow, it's going to go down by 1 rand 84 per litre, the biggest price drop we've ever had. That will reduce inflation going forward, and it will also stimulate the economy. Excuse me. It will stimulate the economy as well. One sign of great confidence in Cyril Ramaphosa and in the South African economy is that 2 Swiss banks have decided to open branches here. They are Julius Baer and Lombard Odier. These 2 banks are very conservative, and they would not be opening a branch in South Africa unless they had done their homework and unless they thought that the future for the South African economy was very bright. So that's a mark of confidence in Cyril Ramaphosa and his management of the economy so far. Okay, let's take a look at the rand. Let's try and get that here. Right, I'm going to put 5 years on the screen. So here you can see the channels that we are familiar with. The upper and lower channel lines. This is what the rand was doing for a long time, and then we had this weakening breakout here, which is quite serious because now it's broken above the upper channel line, and the main reason for this was the move from risk on to risk off, which I've discussed with you previously amongst international investors. So international investors withdrew their money from emerging markets and put it into first world countries, usually into government T-bills, like the US 10-year T-bill, and that resulted in the rand weakening. But that weakness was always temporary because it didn't actually originate from South Africa. And as you can see, since then, the rand has been strengthening steadily and looks like it may well go back within this channel in the near future. So our view of the rand is essentially that we believe it will continue to strengthen. Basically because the economy here should do much better next year than it has done this year. In any event, the rand is a very good measure of how things are going in South Africa. It's a good measure of South Africa's progress back towards economic sanity, if you like. All right, now I'd like to talk a little bit about commodities, and I'm going to start with gold. The gold mining industry in this country is in a dismal state. It's got falling grades and rising costs. Over the 25 years that the ANC has been in power, production of gold has dropped from 580 tons to 140 tons. The number of employees employed in the gold mining industry has dropped from 400,000 to about 110,000, and it's probably going to drop quite sharply from there. One of the major gold mining companies in South Africa, probably one of the only ones left here, is Sibanye, and they are locked in a battle with AMCU, the union, and it's Matunjwa versus Froneman. Froneman, of course, is the CEO of Sibanye. The unions are demanding that he pays the lowest paid workers an extra 1,000 rand a month. Froneman is offering 700, and they are coming to blows over that. Froneman's offer of 700 rand has been accepted by 3 of the unions, so it's only AMCU that is holding out. In any event, they are the biggest union, and of course they will cause quite a lot of trouble. They've also threatened to take this strike to Sibanye's platinum mines as well. So it's not only going to affect the gold mines, it's going to affect the platinum mines. And you shouldn't forget that AMCU and Matunjwa were responsible for closing the platinum industry down for 5 months a couple of years ago. So that's something that's happening in gold. Now let's turn our attention to oil. I'm going to just put the Brent price of oil on the screen for you. Here you can see the price of North Sea Brent oil over the last 5 years. You can see how in the second half of 2014 the price collapsed from these levels up here at about $115 a barrel all the way down to $28 a barrel in January of 2016. So that was the bottom, and then since then the oil price has been trending up and going quite strongly. You've got a nice trend line that was developing here. We reached a cycle high of $84.80 over there per barrel, and then a new bear trend seems to have emerged with a breakdown through this trend line. So that's quite interesting, and obviously this is because oil is oversupplied on world markets, and perhaps the OPEC cartel is not quite as good at closing off or cutting back on oil production. At the same time, of course, you will have the shale oil producers coming back on stream, because at prices around, well, anything above basically $50 a barrel, it is profitable to do shale gas, to convert shale gas through fracking into oil. So that is another issue that you should be looking at. However, we do not think that this drop in the oil price will last too long, and the reason we don't think that is because of the recovery in the world economy, which is gradually gaining momentum. And we can see that from a number of things that are going on. Obviously, as the world economy recovers, it's going to be wanting more oil, and that will tend to push the price up, or at least put a floor on that price. Okay, the platinum market is wallowing at prices which make most platinum mines unprofitable. But something has come out which is new and which is positive for the platinum industry. The Chinese government has suddenly decided to start subsidizing the rollout of fuel cells. Now, fuel cells require platinum and platinum group metals to make them work. They are much better than just pure electric motors, because they produce no waste products of any sort except for water. So they are better than an electric motor vehicle which is recharged by electricity which comes from a coal-fired power station, from an environmental point of view. Anyway, the Chinese support of the fuel industry, of the fuel cell industry, is expected to generate a new demand for platinum of roughly 500,000 ounces a year. So that will be very good for the South African platinum industry if it gets going like that. All right, let's now turn our attention to cobalt. You may not be aware of this metal cobalt, but it is a very important metal today, because cobalt is what is put into all modern batteries. And everything in the world today is dependent on batteries. Your cell phone, your laptop, your pad, and quite soon your motor car will all have a battery which contains cobalt. Now, 50% of the world's cobalt is produced in the Democratic Republic of Congo, the DRC, which is quite a politically unstable country, but that's where the cobalt mines are. And what has been discovered is that the cobalt is being mined by children. So there's child labor going on there. And a situation has arisen where a US group called the Enough Project has photographed this and is reporting it on the world markets. And obviously it's very difficult to determine whether the battery in your phone or your car or computer was produced with using child labor, and people are very sensitive about this kind of thing. Of course, there's now enormous pressure on the DRC to legislate against this and to police the situation more thoroughly. But there is no way to tell what your battery in your phone or car is. Of course, the situation is quite similar to what happened with blood diamonds, and De Beers eventually found a way to mark their diamonds so that they could be. It was quite clear whether that diamond was mined in one of the the mines which were supporting revolutionary activities in Africa. All right, now I've got a few general points which I'd like to just bring to your attention. The first one is Nigeria. As you probably are aware, Nigeria has been trying to force MTN to repatriate about $8.1 billion worth of profits, which they made fair and square and took out of the country over the last few years. They've in fact even taken 75 million rand out of one bank's accounts in order to, because they say that bank was complicit in helping MTN to remove this money from Nigeria. Of course, overseas investors take a very dim view of this. They take a very dim view of the government going into a bank and just taking money without going through due process. You see, that's the problem here. And foreign domestic investment in Nigeria has fallen sharply. Both HSBC and UBS, two big international banks, have closed their branches in Nigeria as a result. So South Africa needs to pay attention to this. Whether we like it or not, we are part of the world economy and we have to play by the rules. And one of the rules is you don't just take money when you want it. You've got to go through due process. There has to be a court case, there has to be an opportunity for that bank to say, no, this money is not due to the government in the form of a fine. They must be able to put their case. All right, moving on from there. The A2X, you've heard about this. This is the competitive stock exchange, which competes directly with the JSE. In our opinion, of the four new stock exchanges which have come into existence in the last year, the A2X is the only one which really offers the JSE serious competition. And that can be seen because Standard Bank and Angloval Industries, two enormous listed companies on the JSE, have decided to take a secondary listing on the A2X. And you should bear in mind that the trades done on the A2X cost roughly half of what they do on the JSE. So now that these two big companies have moved across, and particularly Standard Bank, I believe that there will be other large, heavily traded shares moving across to the A2X in the not too distant future. And of course, this puts pressure on the JSE to drop their rates, and that I think is a good thing. That is great. That's great for us private investors because we will benefit directly from that. And the JSE, after all, has had a monopoly for far, far too long. Another point of general interest is that MTN is talking to China, partnering with China to produce a smartphone which will cost just $20. That's about 300 South African rand. And the plan is to roll that phone out in Africa at a cost of about 300 rand. MTN reckons that they will sell as many as 10 million of these phones. You can imagine the impact of something like this on a continent like Africa. Suddenly, 10 million people will have access to the internet through their smartphone. This is a game-changing move. And at the moment, smartphones in this country, the cheapest one is about 600 rand. So this cuts that price in half and will make it possible for a lot of people to get smartphones who currently can't afford them. Then finally, I'd just like to talk a little bit about cryptocurrencies. I have on occasions talked about Bitcoin in the past, so I thought it would just be appropriate for us to take another look at Bitcoin. Let's go to that chart. Here you can see that on the 8th of December, we wrote an article after this very sharp upward move in the price of Bitcoin. And on the 8th of December 2017, so that's about a year ago, we wrote an article and we said this is a bubble. If you have them, sell them. If you don't have them, don't buy them. And let's hope that you took our advice there. Because as you can see through a series of moves, which we have been tracking, Bitcoin has gone down to a low level, and it was trading with some quite considerable support at around $6,300 per coin. Now that has collapsed, and we're looking now at under $4,000 per coin. Our opinion has not changed about Bitcoins. There are a lot of reasons why you shouldn't buy them, in our opinion. First of all, there's no asset to back them. So you're buying something which has no asset behind it. You know, if you buy shares, you're buying ownership of a company. If you buy property, you're buying a physical asset. Whatever you buy, you've got to look and say, what is the asset? And there's no asset behind these cryptocurrencies at all. And of course, you should also bear in mind that they are used by organized crime to launder money. There's also an increasing incidence of fraud in the markets where Bitcoins are bought and sold, so you should be aware of that. And our advice generally is stay away from it. Okay, let's talk about some companies. I know you want to hear about that, and industries. First of all, I just want to draw attention to the impact of online shopping in South Africa. Now, you may be aware that online shopping has not been a big thing in this country for a long time. In fact, it's been well below 1% of retail sales. But new information coming out now indicates that over the last 5 years, online sales in South Africa have tripled from 6 billion rand a year to 18 billion rand, and that has taken place over the last 5 years. The average South African is now spending roughly 3,000 rand a month on online purchases of some kind. And at the same time that this has happened, the vacancy rate in large shopping centers has tripled in the last 5 years. So one has to think about a development like the new Fourways Mall, where Accelerate, the real estate investment trust, is pouring billions of rands into doubling the size of the Fourways Mall shopping center it will be the biggest shopping center in Africa with over 178,000 square meters of shopping area. Are they going in the wrong direction? That's the thing you should be asking yourself, because it seems clear to me that we are moving towards online shopping. You know, in the UK, online shopping accounts for about a quarter of all retail spend in that country. Of course, in this country, the big online outlet is Takealot, which of course is a Naspers subsidiary. They've produced a very good platform, and their distribution is excellent, and they are benefiting from the rapid spread of smartphones. So from our perception, it is better, if you're going to buy property shares, stay away from retail. That's our advice. Stick to logistics companies, you see, logistics properties, which are basically big warehouses, because these online shopping outlets like Takealot, what they need is warehouse space. They've got to stock their product and distribute it from a certain point, and that means logistics properties, what are called logistics properties. Then the other thing I'd just like to talk briefly about is Black Friday, which happened a few days ago. It's of course the Friday after Thanksgiving, and traditionally that was when the retail stores in America went into the black, and that's why it's called Black Friday, as opposed to being in the red. So up from the beginning of the year up to that point, the retail stores in America traditionally didn't make a profit, but after Black Friday they went into the black, and that became associated with giving big discounts. And it's right at the beginning, of course, of the Christmas sales period, in South Africa it only really took off about 3 years ago, with heavy discounts being supplied by retailers, and each year it's got bigger and bigger in this country. But what is true is that before Black Friday, people tend to save up so that they've got money on Black Friday to take advantage of all the discounts. Similarly, after Black Friday, there's a fall off in retail sales because people have bought electric goods, appliances at deep discounts, and consumables, groceries at deep discounts, and now they don't need to buy so many after Black Friday. So the result of that is that it's doubtful whether Black Friday actually increases the profits of retailers. Also remember that they have to give very deep discounts away. So are they really making money? The financial director of Clicks was certainly not convinced that Black Friday resulted in a bonanza of profits for Clicks. But he said they have to do it. They have to do it because everyone expects it. And of course that Black Friday has now been extended to a week. So some stores are offering those big discounts for as long as a week afterwards. Okay, let's talk about companies. First of all, I'd like to just draw your attention to Capitec, one of my favorite companies and one that I've been punting for a long time. I'm just going to put a bit more data on the screen here. This is Capitec and the share price of Capitec. And I've noted here, this is the point at which the Viceroy report came out. So that was on the 26th of January this year. You can see the enormous impact. It took the share price of Capitec down from its high point here, which was close to 1,100 Rand a share, down to a low of 800, where it found very significant support. At that point, on about the 17th of February, we published an article in which we looked at the price-earnings growth ratio for Capitec. If you're not sure about what the price-earnings growth ratio is, you should go and refer. There are a couple of articles that we've written on it, and it's in the notes, so you should go back and have a look at that and just make sure that you understand what it is. It's a very important ratio because it gives you an idea of whether a share is cheap or expensive at any particular price, especially a blue chip share. So in this case, we did a price earnings growth ratio on Capitec, and we found at that time that it had a price earnings growth ratio of 0.61, which means it represented very, very good value at that time. Just to give you an idea, at the same time, Standard Bank and FNB, both competitive banks, were trading at PEG ratios well above 1, so 1.4 and 1.3. With a PEG ratio, you want the ratio to be below 1. Okay? Anything below 1 is good value. Anything above 1 is not such good value. So there, on the 17th of February 2018, the PEG ratio for Capitec was 0.61. And as you can see, and we published an article and we suggested that you buy the share at a roughly 820 Rand a share. It's now trading for just over 1,100 Rand a share. Okay, around 1,100 Rand a share. And it's still on a good PEG ratio of about 0.71. So it still represents good value in our opinion. And of course, this is because of the fantastic growth in profits in this company. It has the best average performance of profits of any bank. And obviously, leading out of this, you should understand that when a blue chip share like Capitec takes a hammering for some reason, like in this case it was the Viceroy report, which turned out to be complete nonsense in the case of Capitec, then you should always pay close attention, because there may be an opportunity to pick up a high quality stock like this at a bargain price. Of course, sometimes there's a good reason for the fall, as there was in the case of Steinhoff. So you need to do your homework. You can't just go and buy a blue chip share because it's fallen heavily. You need to look at the history, you need to look at the financials, you need to try and establish whether there's a good basis for the share to fall and whether it's going to recover. All right, now I'd like to talk about Pan-African Resources. This is an interesting little company. Normally we don't advise people to buy gold shares because gold, of course, is a commodity and it's very volatile. The price is set internationally. So your average gold mine in this country has got, we describe it as a hole in the ground surrounded by a lot of angry workers. And that is not too much of an exaggeration. But what we are saying is that Pan-African Resources is different. This company is listed both on the London Stock Exchange and on the JSE, and it is in the business of retreating gold mine dumps. So it doesn't have any underground operations. In fact, it's closed its last underground operation, Evander, just the other day, and it took a big impairment as a result, 1.78 billion rand. So now it only has shallow, mechanized mines and retreatment plants. It produces gold at roughly 326,000 rand per kilogram. And when you think that the gold price is 550,000 rand per kilogram, it means that this company is highly profitable. It's also got a life of about 15 years, which means it can continue doing this for the next 15 years. We see this as a very low-cost operator, and it has none of the problems which underground mines have, like faulting, friability of rock, flooding, and those kind of things, which are a big problem for underground mines. And you can see here the share price is on a steady upward trend, which I've marked on the chart here, and we believe that this share will continue to perform well. So if you're interested in gold, if you think gold's going to go up, then this is probably your best option at the moment. The next share I want to talk about is a recent new listing called Motifs. Motifs was spun out of Imperial. So now we've got, where we had one company, Imperial, we now have two companies, Motifs and Imperial Logistics. Those are the two companies. Motifs listed just the other day, and it is a company which owns a lot of motor car dealerships. It has got the exclusive rights in South Africa to import Hyundai, Renault, Kia, and Mitsubishi. It's just bought a Hyundai dealership in Sandton and the Mercedes dealership in Rustenburg. It's got offices also in Melbourne and Sydney, and it has 30 dealerships there in Australia with a plan to grow that to 50. So it's obviously found out how to make money in motor cars in Australia. And of course you must remember that the Australians don't manufacture any motor cars at home anymore. All Australian motor cars are imported. This company, Motifs, has also just bought another dealership in the UK called the Pentagon Group, and so they'll be expanding in that area as well. We see Motifs as a strong blue chip share. I'm not showing the graph on the screen because there are only about 5 or 6 days of trading, and it really doesn't look like anything yet. You can't see anything from the technical side yet. But I believe it's a very well managed, well capitalized business that will be a blue chip in the future. The next share I want to look at is Discovery. This is a long-time favorite of ours. This company, I'm just going to put 10 years history on the screen here. As you can see here, this company is what we call a diagonal, because it goes from the bottom left-hand corner of your screen to the top right-hand corner. So over that period of time, it's gone up from about 625 cents to about 164 Rand. So it doesn't matter that we had Jacob Zuma, it doesn't matter that we had the subprime crisis, right through all those problems and many other problems on the JSE, this company just keeps going on up. So for a private investor, diagonal shares like this are the kind of shares that you just want to accumulate whenever they are weak and put them in your bottom drawer and forget about them, because they're going to just keep going up. What's interesting about Discovery, of course, is its unique vitality approach to insurance, which has now been extended to motor car driving, and they've now got their own bank, which will be called Discovery Bank. It's going to start operating in March next year, and I believe they will take a big chunk of the AB Income Group banking clients in this country away from other banks like FNB and Standard Bank and so on. And that is because they can offer fantastic cross-selling discounts to their new Discovery Bank clients. Discovery is sitting on a price-earnings ratio of 22, which is very demanding, and it's got a dividend yield of 1%. And that shows just how highly rated this company is. Everybody wants to hold these shares, nobody wants to sell them really. Okay, so let's now look at a company called Transaction Capital. Now, Transaction Capital is a uniquely South African company. And the reason I say that is because this company covers the whole value chain of minibus taxis in this country. So they buy taxis in bulk and they sell them to the taxi industry. They finance them through their finance company. They insure them through their insurance company. They repossess them through their repossession company. They repair them and fix them. So they cover the whole value chain of the taxi industry in this country. And as you know, the taxi industry is everywhere. And they obviously are making very good profits out of this. They're a relatively new company, so they're only listed in 2012, but since then they've had a compound growth of 20% per annum in their earnings per share, and their dividends per share have gone up by 33% per annum. If we look at the share over the last 5 years, well, really since it's listed, it's basically shaping up to be a diagonal. Can you see that? It's going from the bottom left-hand corner of your screen to the top right-hand corner. So we reckon this is a good one. In the year to the 30th of September, their headline earnings per share jumped by 16%. They also reported that they've now made a deal with Santaco, which is the South African Taxi Association, and that company will own 25% of one of their biggest subsidiaries called SA Taxi. So we see this as a good share, one that you probably should include in your portfolio. The next share that I want to look at is an old share called Lewis. Now Lewis sells furniture, okay? So they are a company that has a lot of furniture outlets in South Africa. In fact, they've got 780 stores throughout the country. They sell furniture and electrical appliances like big white goods like washing machines and fridges and so on. They've also got 116 stores in neighboring countries. 66% of their business is done on credit. So only 1/3 of their business is cash business. The rest is done on credit. Now, they got into a lot of trouble a couple of years ago, and you can see this from the chart. And the reason they got into trouble is because they were selling insurance to people who didn't need it, and to people who didn't have any product from them and so on, and they got into a lot of trouble with the authorities, and that caused their share price to fall from about 100 Rand up here down to this bottom level at about 25 Rand. However, at this level, and where they are now, they're on a dividend yield of about 5.5% and a very undemanding PE of about 9. This is a company that will benefit directly from any recovery in the South African economy, because the first thing that people do when the economy gets going again and they start earning a bit more money is they go and buy a new lounge suite or a new bedroom suite or a new fridge. And these people are the people that they will buy that from, most probably. So, take a look at Lewis. I think it's cheap at current prices. British American Tobacco. Obviously a huge international tobacco company. Second biggest company trading on the JSE, second only to Naspers. And they have all sorts of big brands like Peter Stuyvesant and Camel and all the other big cigarette brands. And they operate all over the world. They've been trying to switch out of cigarettes and into vaping and electronic cigarettes, but that is not going so well for them. But it doesn't really matter, because 20% of the world's population smokes on a regular basis. So they've got a massive market. The reason I draw this share to your attention is because at the moment, in this little island formation that you can see here on the right-hand side of your chart, this share is trading on a PE ratio of about 4.1. And that looks like hell of a good value to me. So if you can get over your distaste for the smoking industry and you feel like you would like to invest in something like this, this is a fantastic opportunity. I don't see them staying at a PE of 4 for very long. All right, now the last share I want to look at is a company called Into, which on your share friend you'll find it if you type in ITU. So don't type in INTU, type in ITU. And there it is, Into. This is a property company. It's a real estate investment trust, and it operates 17 shopping malls in the UK and 3 in Spain. Those shopping malls have an occupancy of 97%, which is very good, and their rental income went up by 1.3% in the most recent period. Of course, the share has been hit by Brexit, so it's come down quite strongly. And then the other day, they had an acquisition. So a company was looking to buy them out because they were so cheap, right? At around 36 Rand a share. And you can see how that deal caused the share price to jump up to about 35, 36 Rand here. And it stayed there while the deal was on the table. And then the other day, the deal was taken off the table. So it's no longer there, and the share price fell, but it didn't just fall back to where it was before at 28 Rand. It fell all the way back to 20 Rand a share. 20 Rand a share. So now what is this that you're buying for 20 Rand a share? Well, you're buying shopping malls in England and in Spain. Spain is one of the fastest growing economies in Europe now. And the net asset value of those shopping malls in those two countries is 63 Rand a share. So this share is trading for 1/3 of its net asset value, and those assets are property. It's not like they're dealing with, the assets are not intangible. They're solid properties which are being properly valued. So I believe this share is ridiculously cheap now at 20 Rand a share. And I appreciate that Brexit is coming and there are some unknowns. But you know, if you want to buy 17 shopping malls in the UK and 3 in Spain, you're not going to get them cheaper than this. Ladies and gentlemen, thank you very much for listening to me this afternoon. And just bear in mind that the next presentation that I do will be in February, the first Wednesday of February, most probably. So we will not be doing one in January because there's literally over the Christmas period, there's generally not a lot to report. So have a good Christmas. We wish you all the best for the festive season and all the best for the new year. And I'll be talking to you again in February.